Okay, so Unit 4.2 Sources of Finance. Now, sources of finance in a business is goes about in two ways. We have internal or we have external. Right now, we're going to look at the internal sources of finance as a business can. When I talk about source of finance, I'm talking about methods that businesses can occur or operate in order to obtain finances and obtain money, basically. Okay, so the first internal source of finance is your personal funds. This, if you need to define, is the internal source of finance that comes from your owner's savings. Now, when we look at sources of finance, we have to think about their ability and their how we should use them, because you shouldn't always use a random one. They are specific to specific situations, and as a business management student, you have to be able to decipher when you should use a different type of finance. So as for personal funds, you can only use this if you are sole traders or partnerships or an unincorporated business with unlimited liability, because there's no that separation of legal identity. So you need to work with your own money, your own personal funds. And it is a short-term and long-term method to obtain finance. It can work both ways. That's fine. So the advantages of personal funds is you don't need to repay. This is for every single internal. No need to repay, that means no interest cost. Secondly, it's so much more easier to borrow because you're taking from yourself. And a side benefit is you look a lot more committed into your business because people can see you are investing into yourself. So, disadvantages, very high risks. If it doesn't go well, the investment doesn't go well, you lose all of your own personal funds, okay? Very high risk, you're putting a lot up there. Secondly, personal funds are very rarely sufficient enough to actually go on with business operations. Okay, so the second internal source of finance is a retained profit. This is the internal source of finance which comes from a financial surplus of a business, which is then reinvested back into the business. Now, when we talk about retained profit, now let's go back to specificity. You can't use this for any new businesses because they won't have a retained profit if they're new. So this is only for well-established businesses. And once again, it can also be short-term or long-term. So the advantage is, once again, you don't need to pay and you have so much greater flexibility because it's your own profit once again, so you can use it whatever way you want. You don't have any, since it's not anyone else's money, you can do whatever you want with it. Disadvantage is, since if you use your retained profit as a source of finance, you will have to pay less dividends to your shareholders, which could cause big conflict in your business. So you need to make sure that you're able to compete with these stakeholder conflicts. And once again, it's almost the same as personal funds. It is rarely enough to actually fund business operations and practices. Now, the last internal source of finance is the sale of assets. This is just the internal source of finance to sell assets that are not currently needed in your business or that will be reinvested into to improve the better assets. An advantage is, once again, as always, no interest, no need to repay it, which means it's just bang, done it, no extra costs. And secondly, when we talk about sale assets, it helps you reduce waste, because when you sell assets that you don't need, you are boosting your efficiency because they're not needed anymore, or you can get much more efficient, much more productive machines or assets. But selling assets is very time consuming because it's not something you can just sell immediately. It's not very liquid, okay? So it does take a very long time. Secondly, it can hinder your productive capacity because it's time consuming. Maybe selling your assets will take a long time, but then receiving new assets to, reinvest takes even longer, which hinders your productive capacity. And yeah, that's the internal sources of finance. Okay, so now moving on to the external sources of finance. All right, so let's start with share capital. Share capital is finance that you raise through the issuing of shares through your stock market, okay? So, what did you call it? Well, that is my fault. Yep. Finance is raised through the issuing of shares through the stock market. Okay, so this basically means when you dilute more shares into the stock market in order to gain more profit as more and more people buy these stocks. So an advantage is this is a permanent capital. You don't need to repay this. And before you get that, this can't be used by like new businesses because it has to be quite a big business in order to be on the public stock exchange. So it has to be a very well established business. And then it's usually a long term method. So, secondly, it helps improve your company's gearing ratios because you're not borrowing money from anyone, yet you're still replacing money. We'll cover gearing later. So, disadvantage is that your control of your own company diluted. You now have a lower percentage of shares than you had before, so you lose power and control, which means your decision is less important. And then secondly, you have to pay a lot more dividends because you have a lot more shares, which could be more costly in the long term. So secondly, we have loan capital. Now, another way of saying loan capital is just a fancy way of saying bank loans, okay? Bank loans are just big loans. And these are financial debts of the borrowing of money from financial lenders, so banks. But loan capital covers more than just banks and insures financial lenders. So this can be used short term, long term, and it can be used. It is better for established business, but anyone can use a bank loan. So the advantage is that you can repay in regular installments. You don't need to repay all at once, which helps you maintain cash flow. Okay? Secondly, with loan capitals, you can access lots of financial economies of scale the bigger you are. So that means you can pay less interest, you can get more borrowing amounts, longer borrowing length periods. It's a lot better. So, disadvantage is obviously interest. It's high interest that will stack up as you have to pay off these bank loans. Secondly, is when you give loan capital, you have to put something up as collateral. That means something's there that in case you go insolvent or bankrupt and you're not able to pay them back, they will take whatever is as collateral in order to ensure that you can pay them back. So, third, we have overdraft. Now, overdraft is very close to a bank loan, except it is in the short term, very short term practice. And it's it's the banking service of when customers withdraw more money than there is in their bank account. So if I have $100 in my bank account and I withdraw 150, that is an overdraft of $50. Now, this, once again, is very short term, okay? And the advantage is it's so easy to get in banks nowadays that you can just get it instantly. And secondly, it kind of forms and acts as emergency funds. If you have no other options, you need to pay something right now, it's right there, super easy to get. But this comes with big disadvantages, because this is the reason why I use it as emergency fund is because there should usually always be a last resort, because the interest rates that come with overdrafts are extremely high, okay, and they can also be asked to be repaid in very short notice, and if you don't repay them in short notice, they will just keep increasing the interest rate. So let's go to the fourth one, crowdfunding. Crowdfunding is raising small amounts of money from a large amount of people. That's if I went to like 1,000 people and I asked them all for $10 each. That is small amounts of money from a large amount of people. So this is a short-term or long-term tactic and is used usually by like small to medium level enterprises or businesses. So an advantage of this is that you don't lose any control. You keep all the control in your stuff, And secondly, you don't have to deal with these commercial banks and their super high interest rates and their formality and their bureaucracy. Okay? But when it comes to crowdfunding, you need to do lots of due diligence. Because if you're going to take from so many different people, you need to see, okay, I need to take 10 from you, 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 10 from you. And that just takes, due diligence means a lot of work and the effort that's put in. And then secondly, you need to hold regular meetings and share your finances and your documents with them, which could also increase bureaucracy and make it more public, which sometimes you don't want to do as a business. And fifth, we have leasing. Leasing is when you draw up a contract to use for other people to use your non-current assets for a fee. So if I have a warehouse, okay, and there's I am business A of the warehouse, and business B wants to use a warehouse, they will contact me to lease the warehouse for a 6-month period. I will give it to them 6-month period, and over that monthly they will give me rent because they're leasing it. That is an example of leasing. Now, a big advantage of this is that you get fixed regular payments as the person who is leasing it out. This helps you ensure cash flow because you get fixed revenue monthly or however long your contracts are made up for. And then also it helps you minimize your waste because you won't be leasing out these non-current assets that you need, that are vital for your business, because you need to use it yourself. So the stuff you don't really need but you don't want to sell is stuff you can lease, okay, so that you can make sure you're making most of it. However, when you lease something, so let's go back to that warehouse example, you rely on the leasee or the leaser to maintain the same quality of your non-current asset and not ruin it. So if company B came to our warehouse and just ruined the whole thing up, okay, I can make them pay it back, but that is still a burden on me to fix everything and get everything back to order or back to place, back to original. And secondly, I lose responsibility. So let's say in the future I may need to use that warehouse again. I can't because now I'm leasing it out to someone else and I lose my responsibility of my non-current asset for that dictated period of time. Alright, so sources of finance, the extension of the external ones. So now, number 6, we have microfinances. These are when a for-profit social enterprises offer financial services to the underprivileged, okay? So this only applies if you are underprivileged or you are unable to access the normal forms of finance that we have discussed prior to this. So an advantage of this, it benefits your wider community, okay? And it helps people come out of poverty. So it's really good for society, and that's why a lot of for-profit social enterprises do microfinances. However, there do sometimes be relatively high interest charges, and the loans itself are usually very small as they're not massive in the amount they give. So, 7, business angels. Business angels are wealthy and successful private investors that risk their money in a venture they believe has high growth potential. Now, if you want to understand what business angel is, the best way to think of it is Shark Tank. All of those guys, they're all supposed to be business angels, okay, because they all are wealthy, successful investors in their own that see high growth potential in other businesses and help them by practically buying a percentage of it and investing in it. So an advantage is obviously these business angels, as they're wealthy and successful, have lots of expertise and lots of experience, which means they have such a great network for you, and you can just utilize all of their advantages to help you and your business. Secondly, you get such a great trust in your business, because if I was a business getting backed by Mark Cuban, people would think that I'm legit. Because it gives a sense of like legitimacy, because they trust the business angel, so they trust me as a business. Now, a disadvantage is that business angels are very hard to come by. It's not a normal thing, and you need to be absolutely special and shining as a beacon, because obviously these guys are not just going to invest in every single thing they see. Secondly, once again, you dilute control because you have to give up a certain percentage of your company to these business angels. This loses you power, control, and some future profits. And lastly, we have trade credit. Now, listen closely. Trade credit is something that enables your customers to purchase and obtain products, but to pay for these at a later date. So, a good example of trade credit is what we call in today's world is buy now, pay later schemes. I can buy now this product, okay? Let's say there's a timeline of 2 weeks. I go to a factory and I buy my shipment of pens, okay? Right there on the Monday. Now, by offering trade credit, this business, the factory, gives me till next Tuesday for them that I can send them the money. So I buy it and I obtain my products on Monday, and then on the next Tuesday, that's when I pay them. That is basically what trade credit is. So this is good because it helps you sustain your cash flow. You don't have to pay everything at once. Trade credit means also you can pay in sums in the future. You don't always have to pay at once. It helps you maintain cash flow, a healthy cash flow, if your business is ever cash poor. Secondly, it helps you build customer loyalty. By offering trade credit, customers feel more valued and feel more appreciative of your services, which means they will come back more. However, there are lots of late payment deadlines, so if I don't pay by that Tuesday, there will be big fines and charges that I'll have to incur. So I have to make sure I can pay with these trade credits. And there is also a risk of over-reliance on these trade credits because sometimes it can be called back and I'm relying on the trade credit to be that far away because I won't be able to pay then. So that is all of the sources of finances. Yep. Okay, so this chart right here is kind of just a brief explanation on how to kind of decide what type of finance you should be using if you've ever been asked a question. Now, this is not concrete, this is not from IB, this is just something I've kind of thought of. Actually, it might be from IB. I actually don't remember. I got this in class. So, firstly, when you look at what type of finance you need to look at, you have to think about what type of expenditure you're going to use it on. So back in 4.1, we talked about revenue expenditure and capital expenditure, okay? So revenue expenditure, once again, is that day-to-day cost, and capital expenditure is that long-term cost. So if we think about what type of expenditure we have to call when we're looking at what source of finance to use, let's look at our revenue expenditure first. When we have a revenue expenditure and that we need to get a source of finance, we have to first think about, does the firm itself have enough funds? If so, we go straight down to using your own internal sources of finance. But if we don't have enough, okay, yes, no, yes, yes, no, small, long. Yeah, so if we do have enough funds, we use internal sources of finance. If we don't, we'll use short-term external sources of finance when we're looking at revenue expenditure. So let's move away from revenue expenditure. Let's go into capital expenditure. When we look at a capital expenditure where we need a source of finance, we ask ourselves the same question. Does the firm have enough funds? Now, if we do have enough funds for a capital expenditure, maybe last year was a great year, we have so much retained profits, yes, we use internal sources of finance if we have enough funds. But if we don't have enough funds, we got to think of another question. Is the capital expenditure a small or a large expense? Okay, so this is relative, so you have to figure out as a business owner and a business manager if it is a small or large, because nothing is very concrete. But if you have determined it is a small expenditure, then you use short-term external sources of finance when you don't have enough funds. But if you've determined it's a large expenditure, then you use long-term external sources of finance when the firm does not have enough for capital expenditures. And that wraps up all of sources of finance. And yep, that's about it.